Jamie Dimon, the CEO of JP Morgan, and his inner circle have sold nearly 170 million worth of shares in the bank as the share price hits a new all-time high. We have articles including that from Morningstar whether or not this could be a reason for caution, not just with JP Morgan but also the stock market. And in today's episode, we want to find out whether or not we should be looking to sell JP Morgan stock similar to the CEO and whether there should be any cause for concern in terms of the stock market ahead. As always, we'll run through the performance of JP Morgan over the last few years. We'll also take a look at how well their company has progressed over the last few years, whether it's justified in their recent run-up to their all-time high. We'll also have a quick look at the health of the company, a total cash versus total debt, and we'll see how they're performing versus others in the industry of banking. We'll also take an in-depth look at the sales that they have performed, the number of shares as well as the percentage, and we'll take a look at institutions, whether or not they're still adding to JP Morgan over the more recent quarter. And don't forget, we'll look at that dividend safety, we'll jump into some of their financial metrics, and we'll conclude with our valuation of this company, getting to our intrinsic value as well as our acceptable buy price, and look at Wall Street's forecast for the next 12 months. So jumping straight into the company performance, what we can see over the last year, it has had a very strong run if you remove the tech and AI companies, up 32%. We can see now trading at its 52-week high with a yield of 2.28% and a forward PE of 11.56. Now, if this is one you have been holding over the last 10 years, well, it would be an all-time high for you, up around 224%. But again, if you include those dividends reinvested, it would be slightly higher. In terms of how they're progressing, well, in terms of their total revenues over the last few years, it has gone from around 110 billion, as we can see in 2019, to 146 in their more recent annual report of 2023. So nice growth over the last 5 years, and we can also see on a more granular level that drop from 2019 to 2020 before picking up and then a drop and then increasing. So we can see their top line is pretty inconsistent, but over the longer term that top line figure does increase. And when we compare it to the bottom line net income, we see a pretty similar story here. Whilst it has increased from 36 billion in 2019 to 49.5 billion in 2023, we also see the inconsistencies, the dropped in 2020 as well as picking back up before dropping again. So yes, the top line and the bottom line are increasing year on year, but just bear in mind the inconsistencies and also the effect that the market does have on this company. Now, in terms of a quick health check, total cash versus total debt, they had around 217 billion of cash in 2019. We can see this increase significantly to the latest quarter of 605 billion. So they do hold a lot of cash. We can also see that their total investments has increased significantly from 2019, nearly around 40%, so quite a large jump. Now, when we compare that very quickly to their total debt, we can also see that that has also increased, although at a slower rate, 589 billion to 731. So no real worries there in terms of looking at that balance sheet. They do have a pretty solid balance sheet with a strong cash position as a strong investment position versus their total debt. In terms of looking at some of their competitors over the last few years, we have Bank of America, Wells Fargo, HSBC in the banking industry. Now, on a total return basis, including those dividends reinvested, JP Morgan was the best performing, up 35.5%. And we can see their closest competitor was Wells Fargo, up 20%. So both pretty strong returns over the last 12 months. When we extend that to the last year, we still see JP Morgan up 101%. Very, very solid performance. But this time we see RY as the second closest competitor. Only thing we would say is they have had a strong run over the last 5 years, JPM, but bear in mind past performance isn't an indicator for future performance. Now looking at the institutional ownership, we see around 69%. We see around 23 billion worth of sales by these institutions over the last 12 months. Over the same period, a lot more buying, so we can see institutions do quite like JPM. They have been buying a lot more shares than selling, with the largest buy ultimately coming in Q2, as we can see here. Green depicting inflows, red depicting outflows. We do also note a lot more buying in Q3 and in Q4 than we see selling. So ultimately, institutions are in favor of this company. Now, very quickly, we're going to take a look at the insider buys and sells. We can clearly see there are only selling. One thing before we jump in that I just want to point out, when we are looking at this, typically what we say is that insider buys is a very bullish signal. The reason, well, management do buy because they believe the share price will go up. That is ultimately why. Insider sales, less so. We wouldn't consider it a massive bearish signal. Do bear in mind, insiders do sell, whether that's for personal or financial reasons as well. So what we can see here, James Dimon, chairman and CEO, on essentially the 22nd of February, a few days ago, sold over 821,000 shares at $183, bringing in around $150 million. We can see other members, the general counsel, selling around $1 million worth of shares. We have the chief information officer as well of around 716,000. Now, the thing that we would say, obviously what does point out massively is James Dimon, the CEO, selling his shares, is that this was part of what the plan was when we were looking in 2023. As we can see from this article, October 27, 2023, we see here that JP Chase stock slips after the bank CEO, Jamie Dimon, says he is selling around 1 million worth of shares. And we can see here he was expecting to sell this next year, therefore 2024. So yes, it is at an all-time high, and yes, he has sold. But again, this was something that he was looking to do last year. Now, when we take a look at some of their metrics, we can see that dividend safety ultimately sits at 60, borderline safe. Market cap, 530 billion, a mega cap company. In terms of those recessionary metrics, for those that see a recession coming, well, they cut the dividend in 07-09. We can see they had below average growth, negative 30% versus the S&P's negative 12%. And we also see they trailed the S&P return, negative 65 versus the S&P's negative 55. In terms of dividend growth, well, they increased it 5% last summer. As always on the channel, we advocate a minimum of 4% just to keep up in line with inflation. Over the last 5 years, 9% looking fairly solid. Over the last 20 years, at that 6% level, it is okay, nothing too great, but again, they do offer a fairly decent starting yield. Now, we can see they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, well, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of overvaluation, but do bear in mind we don't look at any of these models in isolation. 2.28 versus 2.9, and we can see the forward PE pretty much in line with that 5-year average of 11.3. And we can see, in fact, JP is also in line with the sector PE of financials of 11.5. Now, typically on the channel, we do focus on the free cash flow payout. However, for banks, their earnings, their cash flow is a lot more volatile. So we focus on the earnings payout. Below 40% is the metric we want for banks when we want to be industry specific. Other than 2020, it has been below that, 25% in 2023, 26% expected in 2024. So no real worries noted there. Ideally, we would like to see a nice high single-digit increase to the dividend this summer. They've also been increasing their earnings per share more than 3 times, from $5.29 in 2014 to $16.20 in 2023. Nice growth, as we can see, not massively inconsistent either, which is nice to note. But we do see here in 2024 it is expected to be fairly flat, dropping down 20 cents to $16. Sales growth, we can see here double-digit growth in the more recent report. Nice to see 19% growth. But we do see some inconsistencies across the period. However, nonetheless, numerically, we do see it increase by around 50% over the last 10 years, 92 billion to 146. They also do share buybacks, returning excess cash to investor pockets, as we can see, reducing that share count from 3.8 billion to 2.94. So again, that is a nice bonus for investors alongside that dividend. Speaking of shares outstanding, we have just released our latest article on share buybacks, running through essentially companies that aggressively buy back shares, bringing about a lot of value to investors. If you want to read this or any other articles completely free by clicking on that pinned comment below, and later today we will be releasing another article for you. So let's take a look now at the other metrics. So we have the ROE, return on equity, that we use for banks. We want to see 9% or more specifically for this industry. And what we can see over the longer term, it has been increasing 16% in 2023 and consistently above that 9% level. So lots of positives, especially when this is a very important metric in your investment thesis. Now, the other metrics that we typically use aren't meaningful for banks, as interest isn't a core component of their revenues and expenses, and as we mentioned with the free cash flow, it is a lot more volatile. The same applies to that net debt to EBITDA that we use. Again, EBITDA not meaningful for banks. As we said, interest is a core component. So let's jump into the valuation model. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, jumping into the first model, we have Graham's valuation. We have the stock ticker symbol, the earnings per share, the growth rate per analyst estimates, and that AAA corporate bond yield. We get an intrinsic value of around $161. Now, given that market value of $183.84, we have our first sign of overvaluation, but do bear in mind we're not looking at any of these models in isolation. We then have the multiples valuation model, companies in a similar sector and size, their PE multiples. We get the average multiplied by the EPS of JPM to get an intrinsic value now of undervaluation. So we can see one model showing under, one model showing over. We then move on to the third model, which is the dividend discount model, the DDM. Nice dividend growth over the period. We see the more recent one at around that 5%. We have gone slightly higher than the more recent increase, but a lot lower than the average, so we do believe this is fairly conservative. And we get an intrinsic value around $5 shy of the current market price, showing another sign of overvaluation. Again, given the discounted cash flow model, it won't be used given the volatility to that as mentioned. So let's get into the intrinsic value, which is just the average of these three models that you see on screen. And as always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. Margin of safety then, whilst we typically use 10% if we believe it has a wide moat, strong financial metrics and good forward-looking data, we can already see the intrinsic value is pretty much $1 or $2 shy from that current price, so there is 0% of a margin of safety. However, for those that are looking for around 10%, you would be looking to buy around 163, and those looking around 20% around 145. Now, what we can see is it looks like the CEO and some of those members of the inside management have been selling around what we believe to be the intrinsic value. Now, this doesn't necessarily mean this is the top. The share price could continue to increase. And as we mentioned before, just because insiders, even the CEO, sell, it isn't necessarily a bearish reason. And they can sell whether it's personal or financial. Don't forget, as we showed in 2023 towards the end, he was having a plan to sell around 1 million shares in 2024, where the share price back then was a lot lower. In terms of Wall Street and their forecast, well, they see a price target of $193, so they see upside of 5%. So in reality, just because the CEO of a big bank like JP is selling some of his shares, it isn't necessarily a bearish signal for the rest of the market. However, it is one just to be aware of, as we mentioned and as we ran through. It does look, in our opinion, that JP for this company specifically is trading around this intrinsic value. As always, let me know your thoughts in the comments below whether or not JP is one you're looking to buy, maybe even sell at this point, similar to the CEO, or if you hold other stocks in the market, whether or not you see this as any indicator of that. As always, have a great day, see you on the next episode, and take care for now.